Okay, friends, let's start with an analysis of Dodd-Frank, which came in the aftermath, of course, of the subprime mortgage crisis. The way federal legislation regulating business tends to work is whenever there's some big crisis or some big scandal, the government will actually pass laws due to popular opinion regulating the crisis or scandal that just occurred so that that doesn't happen again. And those regulations are typically quite expensive and they're very inefficient, and time passes, and as long as no big scandal happens again, businesses will over time lobby for a repeal of various parts of the law. And those parts of the law will be repealed or be loosened, and regulations will become looser, and then basically the cycle will repeat itself. Some big scandal or some big crisis will happen, and the government will tighten regulations again due to popular outcry. That's exactly what's happened with Dodd-Frank. Dodd-Frank initially started out as an incredibly restrictive regulatory set of legislation components, and it has over time, piece by piece, been repealed so that things are actually much looser than they were when it was originated in 2009. But let's look at its components because it's still a very powerful and important law. Alongside Sarbanes-Oxley, one of perhaps the two most important in finance today. The FSOC, or Financial Stability Oversight Council, was established by Part 1 of Dodd-Frank. The purpose of this council was to identify risks presented by bank holding companies and non-bank financial companies, to promote market discipline, and to respond to threats to the stability of the U.S. financial system. I mentioned earlier that in 2008 and 2009, the government bailed out a bunch of bad actors, lenders who had initiated mortgages that they probably shouldn't have initiated, taking on too much risk. But the justification for this bailout at the time was systemic failure. The fear was that if the government didn't bail out these bad actors, then there would be a loss of confidence in the banks and in the financial system more generally. And so it was thought at the time that this is still a very controversial measure at the time, but the majority at the time thought that the bailout was justified because it would stabilize the financial system. And that's what FSOC was established to do, was to regulate the stability of the financial system. In order to also convince people to keep their money in the banks, not to pull their money from their checking and savings accounts, there were deposit insurance reforms that were implemented by Dodd-Frank. So FDI assessments for most banking institutions are strengthened by Dodd-Frank. Your savings account and checking account, those are insured for up to $250,000. And that's verified by Dodd-Frank. Let's look at part 2 of Dodd-Frank. I'm going to make this go as quickly as possible, guys. This is the mortgage reform and anti-predatory lending part of Dodd-Frank. Okay, I mentioned that the banks, a lot of them were predatory. They were trying to target customers who weren't especially financially savvy and didn't really know what they were doing, using loan products that were exotic and that customers couldn't understand. So Dodd-Frank attempted to resolve this by creating a federal duty of care, which requires the licensing and registration of mortgage originators. All borrowers now have to have a documented ability to repay the loan and have to be provided with a net tangible benefit from the loan. Okay, because of course at the time of the subprime mortgage crisis, a large number of borrowers were taking out loans where it was clear to anybody who could analyze the situation that they were not going to be able to repay this loan. And banks would do this for predatory reasons. Loans can't have predatory characteristics, and loan documents also have to contain full disclosures as well as the originator's unique identifier. All of this is an attempt to tighten up restrictions on mortgage originators. There are now punishments for originators who violate these restrictions. Originators who violate the duty of care now are liable to borrowers for greater amounts. Okay, they're liable to the government and also to borrowers. This is the actual amount that they're liable for. You don't need to remember that part, just that they're now liable to borrowers for greater amounts. Okay, the last part of part 2 of Dodd-Frank is the government's attempt to privilege qualified mortgages. Okay, a mortgage is an interesting product. It's a secured loan, and the collateral is the house itself. So the interest rate on the loan is lower than the interest rate is going to be on, say, a personal loan or a credit card loan or something like that. Okay, but at the same time, mortgages come in a variety of different shapes and sizes. Some mortgages have variable interest rates. Some mortgages have low interest rates at the beginning and much higher interest rates later on. Okay, the government wanted to privilege fixed rate mortgages. These are what the government highlights as qualified mortgages because it was seen as a safe, easy to understand financial product that lots of different customers could access and mom and pop could grasp. One of the big issues that Dodd-Frank tries to resolve is making financial products available to mom and pop, even when mom and pop don't understand finance. Okay, and the qualified mortgage idea was an attempt to do this. So qualified mortgages are defined as having the following characteristics. So fully documented 30-year fixed rate with no negative amortization features. The 30-year fixed is what my wife and I have as the mortgage on our house. Okay, the APR cannot exceed the average Fed prime rate by more than 1.5%. Okay, so that restricts banks from doing predatory kinds of practices. Again, this is just qualified mortgages. This is not all mortgages, but these are the kinds of mortgages which are being privileged by the government. It has to be an underwriting based on a fully indexed rate. The income and other financial resources of borrowers have to be verified. Now this is done to a much greater extent than was done prior to Dodd-Frank. You have to go through a large number of hoops these days in order to secure loans of this kind by demonstrating your financial soundness as a customer. It also has to meet debt-to-income test requirements that are prescribed by federal banking agencies. Okay, and actually, Marissa, you're our local real estate agent. You can enlighten us.
Well, I was wondering what is considered a predatory characteristic, just lending out to somebody who obviously can't pay it back?
Sure.
Taking advantage of that?
Sure. So that would definitely be predatory, is taking advantage of someone's greed when someone quite obviously can't repay a loan. But one loan product that we talked about last time is what Rebecca mentioned, called a balloon loan. If you check your credit card advertisements in the mail, you'll notice that a lot of them say 0% APR for 12 months, or some introductory rate that's much lower than the standard rate that it later becomes. Okay, and that's a kind of a characteristic of a balloon loan. A balloon loan is a product that makes sense for some customers. It starts out at a very low APR, but after a certain period of time, like 5 years, it'll spike to a much higher APR. So maybe its APR at the start is 2.5%, but after 5 years, it jumps to 17.5%. And customers see the low introductory rate, and they believe themselves to be on a financial trajectory where they're going to be much better off within 5 years or something like that. And that introductory rate fools them into taking such a product, when in fact they actually are not able to repay it once it reaches the higher
But stuff like that
APR.
still exists.
Oh, absolutely. It absolutely still exists, and it's good for some people. It does make sense for some kinds of customers. So for instance, if you're a customer who needs the loan now, so imagine I'm a med school student and I've got 3 kids, then I'm not making much money now, but within 5 years, I'm going to be making a ton of money when I open my practice. Okay, you can repay this within a short period of time. So the 2.5% rate makes sense for that kind of a customer. But it doesn't make sense for a customer who doesn't have professional prospects that are going to dramatically improve within that 5-year window. The predatory nature of this is very controversial. Okay, because basically, and in fact that goes for all of what we're going to talk about with Dodd-Frank today. Okay, basically, the government in Dodd-Frank is attempting to decide on behalf of customers what's predatory and what's not, rather than allowing those customers to decide for themselves. Okay, and that's the controversial part, is that Dodd-Frank is an attempt to protect mom and pop from themselves. Okay, this is dicey, the idea that people should be protected from themselves, because to protect people from themselves, you have to infringe upon their liberty. And that means restricting their access to certain kinds of financial products. Okay, and telling them, no, you are actually not sophisticated enough or not qualified enough to be able to handle these kinds of financial products, or to be able to make decisions for yourself about whether or not you should have access to these kinds of financial products. We're going to make those decisions on your behalf. Okay, and that's the controversial part about Dodd-Frank, is that it made law that kind of thinking where people should be protected from their own bad choices. Do you have any follow-up on that? Cool. Okay, and in fact, let's go right to that right now. This is perhaps the most controversial section in Dodd-Frank, is Section 3. This was Elizabeth Warren's baby. Okay, she's a recent Democratic presidential candidate. The independent bureau at the Federal Reserve called the BCFP, or Bureau of Consumer Financial Protection, was set up by Part 3 of Dodd-Frank, with rules and orders that are not subject to Federal Reserve review. Okay, we kind of all know what the Federal Reserve is, at least we've heard of it. The Federal Reserve is a very, 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 very powerful shadow government in the United States, perhaps more powerful than the actual government itself in some ways. Okay, and it runs the banking system by setting the prime rate, among many other things that it does. Okay, the BCFP is at the Federal Reserve, but it's not subject to Federal Reserve review. This is not a lecture about the Federal Reserve, but if you ever have any questions about the Federal Reserve, I can help you out with that. The FSOC, or FSOC, is involved and can set aside its final regulations based on safety and soundness concerns. Here's the job of the BCFP: to regulate the offering and provision of consumer financial products or services under the federal consumer financial laws. That sounds innocuous enough. Okay, let's explore that in a little bit greater detail. The BCFP coordinates with other federal and state regulatory agencies to promote the consistent treatment of consumer financial and investment products and services. Okay, again, relatively innocuous. Its establishment of a victim relief fund is also innocuous. Okay, but now we get into a little bit more controversial stuff. The BCFP implements and enforces the federal consumer financial protection laws consistently for the purpose of ensuring that all consumers have access to markets for consumer financial products and services, and that markets for consumer financial products and services are fair, transparent, and competitive. Okay, let me talk a little bit about why the BCFP was controversial. Okay, the BCFP, like I said, is an attempt to protect mom and pop from themselves. Okay, and it does so by separating investors into two classes. Sorry for those who can't see over here. I'm writing up here sophisticated and unsophisticated. And the sophisticated investors, the actual definition of which varies in accordance with different markets and different kinds of financial products. The sophisticated investors, though, are supposed to have access to certain kinds of financial products, and the unsophisticated ones are not supposed to have access to those products. Okay, and that might, in the options market, mean that sophisticated investors are given access to certain kinds of option spreads or options as such, whereas unsophisticated investors are not. Maybe it means in the futures market something similar. In the mortgage market, maybe it means mortgage-backed securities are only accessible to certain kinds of customers and others can't access those. And again, this is because mom and pop couldn't control themselves and brought about the great financial crisis of 2007, 2008, 2009 by virtue of their own excesses and their inability to understand their own financial products and their inability to grasp what was going on and what kinds of loans they were being sold. Does anyone want to take a guess as to the criterion that the BCFP uses to distinguish between sophisticated and unsophisticated customers?
Income or wealth?
It is income and wealth, yeah. It's actually, I shouldn't say income, it's wealth, yeah. It's just wealth. Okay, it's not education. It's actually just wealth. If you have a certain amount of money, the thinking goes, then you can, presumably you had to be smart enough about the financial products that you use to get that money. And so it makes sense that you should be able to access a larger gamut of financial products by virtue of the fact that you were sophisticated enough to make that money.
So
Okay,
like
that's
you
the thinking.
inherited it or you got it from the lottery.
Yeah, it doesn't seem to make sense for those who receive their money from luck or from other people. But what is the government going to use as a criterion if we're going to delve into the deciding on people's behalf what they should have access to and what they shouldn't have access to? If we're going to delve into that world, how can a good criterion be used? This is a rough and ready and easy one because the IRS, of course, has access to everybody's financial statements. Okay, a couple of other functions of the BCFP. It does financial education, it fields consumer complaints and identifies risks. Okay, this is a part of Dodd-Frank that the Republicans wanted to repeal for a long time, but they could never get their act together. There was a lot of squabbling and incompetence during the Trump administration, and so they couldn't ever actually repeal the BCFP. It was seen as something they wanted to repeal because it's not democratically accountable, and also because the whole idea of the government deciding on behalf of ordinary people is something that conservatives tend not to like, because they tend to favor free enterprise over and against regulated enterprise. Okay, but they couldn't get their act together, and now we have a Democratic administration, so it's probably going to be strengthened. Okay, let's look at part 4 of Dodd-Frank. Oh, are there any questions about the BCFP? What about the idea of mom and pop being protected from themselves? There are things to be said on behalf of that way of thinking, and things to be said against it. What do you guys think about that?
I lean to the conservative side of things, so I'm definitely not happy
Mm-hmm.
with the government deciding to, because I think there are chances where they can't evaluate risk. They're not God. They don't know exactly the future. Perhaps it does work out for some people who normally wouldn't have worked out for.
Right, and certainly some people could be financially penalized by virtue of not being able to access the various products that they could otherwise access if the government says they're not sophisticated enough.
Yes. And then with that being said, though, I think a major part of our government and the republic is the idea that a people who can't self-govern is going to need more governance.
Sure.
And so I think it is like a cycle, kind of like you said.
Sure, yeah. Yeah, I guess I'm of two minds on it as well. I don't like the idea of government infringing on freedoms. That's tough to swallow. But at the same time, I mean, I've followed markets and I've followed financial products for a long time, and there are a lot of predatory operators out there. And the great majority of Americans, I mean, they don't even know their credit score, much less how basic financial products operate. And so we're a self-selected group in this class, business-affiliated students, people who are aware of these things. But the great majority of Americans don't have the know-how that the people in this class have. And so while I do resent the infringement on freedom when the government decides on behalf of people what they can and can't do, still at the same time, I get the idea of people being protected from predation. That makes sense to me. Okay, but it is something that's controversial to this day. Some disclosure and corporate governance provisions that were present in Part 4 of Dodd-Frank, and I'm actually going to end here, guys, with 2 more slides. There now have to be stockholder votes on executive compensation. So previously, executives were just voting out by themselves without holding general stockholder votes, what their own compensation packages would be. Now there have to be stockholder votes. Cynically, this doesn't necessarily mean that executives are curbed from doing what they want. So for instance, Elon Musk was able to rig the election at Tesla on his compensation a couple of 3 years ago. and managed to give himself a compensation package that is really out of bounds. Honestly, like, I have never heard of a compensation package like he's getting right now. But he was able to do it, and other similarly dishonest executives can still do things that get around the stockholder vote provision in Dodd-Frank. Okay, heightened compensation committee standards now for all listed companies. There are also whistleblower provisions that are strengthened by Dodd-Frank. It was decided at the time that Sarbanes-Oxley was not enough to protect whistleblowers, and that the provisions of Sarbanes-Oxley would not have been enough to give whistleblowers the protection they needed in order to prevent the subprime mortgage crisis from happening. Okay, so Dodd-Frank strengthened whistleblower provisions. Protection is now expanded to persons who provide original information on any securities law violation. Okay, there are bounties now. Monetary sanctions are strengthened, and also whistleblowers can collect now 10 to 30% of monetary sanctions. So this is given to them as a bounty for the whistleblowing action. There are also stronger prohibitions against retaliation, because retaliation is still a threat when whistleblowers go public with their knowledge. Okay, questions about that part of Dodd-Frank? Everybody good? Okay, let us take a quick break. And when we come back, we're going to do the Barings Bank case, so you guys can see a justification for regulation. And we're also going to cover a sample paper and talk about what I'm looking for in the papers. Okay, so you guys are on break right now. This break's a little bit early, but we'll make it about 2 or 3 minutes, and then we'll come back. Okay, so I want to talk now about the Barings Bank case. Okay, Barings Bank is a long-standing, or was a long-standing British bank with a venerable history dating all the way back to the 1700s. Okay, it was involved in financing a large number of famous historical events, including the wars with France in the 17 and 1800s, participating in the American Revolution, various different governments. Fast forwarding to the present, this bank is famous because it collapsed in 1995 after losing 827 million pounds, which is equal to 1.6 billion pounds today. And this is all traceable to a single rogue trader. So fraudulent investments in futures contracts by a rogue trader named Nick Leeson brought about the downfall. He was stationed in Singapore at the bank's location there. He was supposed to be making arbitrage plays, sorry for the typo, but he held on to the contracts, gambling on the future direction, especially of the Japanese markets, instead of buying on one market and immediately selling on another for a small profit. Okay, he falsified trading records in the bank's computer systems and used the money intended for margin payments on other trading. As a result, he appeared to be making substantial profits. Okay, Barings Bank auditors finally discovered the fraud when the chairman, about the same time as the chairman, received a confession note from Leeson. So basically, Leeson left a confession note and fled on a plane. But essentially, this is an example of why regulation is needed, because this is a rogue trader who was able to hide some of his losses in a way that a more heavily regulated environment would not have allowed him to do. Okay, Leeson operated in both the dealing desk, that is the front office, and also the back office. He had initially had success and was profitable as a trader, but this led to a lack of oversight over his actions. There was also a general lack of surveillance in the bank's trading operations. He, of course, was falsifying everything. And the account regulation procedures at the bank were inefficient. Okay, here are some newspaper headlines. Okay, Leeson is quoted as saying, "We were all driven to make profits and more profits. I was the rising star." In fact, in 1993, he was a very big success as a trader, responsible for 10% of the company's profits. But when he began losing money, he started hiding his losses in a secret account while continuing to inflate his earnings. Okay, this went on for 2 years. And finally, a secret file was found that showed Leeson had gambled 827 million pounds in the bank's funds, which is about 2 billion in today's dollars. He left a note in the firm's Singapore office saying, "I'm sorry," and went on the run. Okay, Barings Bank was eventually bought in 1995 for £1. Parts of it, various U.S.-based operations, the Asset Management Division and the Financial Services Division were split and acquired by other companies. The corporation no longer exists, although the £1 that was paid for the bank allows the purchaser, ING Barings, to continue to use the name because it's got a venerable history, and so the name still has some value. Okay, Leeson said he intended to surrender to the British police with the hope of serving out his prison time in the UK rather than Singapore. Unfortunately, he was stopped by German authorities while in Frankfurt, I believe it was Frankfurt, and was in their custody for several months while unsuccessfully fighting extradition back to Singapore. Okay, so he did go to Singapore, served time there, but the British wanted to control his time in the justice system themselves, and so they pursued extradition and got him back to the UK. Well, he served 6.5 years in prison in Singapore. He did eventually get released 2.5 years early due to having colon cancer. I wish I could say that he's still suffering for his misdeeds, but he is not. He got married, moved to Ireland, became a chief executive of a football club, and then worked as a debt advisory official. It gets worse. He now gives hundreds of talks about how he destroyed Barings. Every talk gives him about $7,900. He has made £200,000 from a book deal and over $7 million from royalties from the movie Rogue Trader, which was made about him. Okay, here's a quote from the director of the bank, or former director. He was sorry it had happened, but it was very matter of fact. He seems to blame the system as opposed to the fact that he is a ruthless and scrupulous cheat and liar. That's what it boils down to. Okay. Anyway, I share this case today when we were doing Dodd-Frank because although regulations can be very onerous and difficult to comply with, having a more heavily regulated environment does prevent rogue actors from doing things like this. And this is just one case, but this sort of thing does happen from time to time, and when it does happen, it's very destructive and disruptive to various parts of the financial system. Questions or comments about this case? Do you guys think you're ever going to lose $2 billion?
Well, I have $2 billion.
The easiest way to become a millionaire is to start out as a billionaire and lose it. All right, let's go ahead and take a look now at a sample paper. Okay, if you'll open up your Blackboard portals, I am unfortunately not able to show you this paper up on the big screen because the big screen seems only to be able to do PowerPoints. Okay, so open up your Blackboard portals to week 8 in the course content folder. And we're going to look at the paper that's titled Sample Business Ethics Paper. Okay, there are also some topic choices that are available in the week 8 folder. If you haven't yet chosen a topic, you're welcome to choose one of those to write on. I'm just going to go through this paper a little bit and talk about the components of a good paper and what I'm looking for. Okay, I'm going to pause for just a minute while you guys all pull it up. This is a paper that's titled The Negative Impact of Unions and Their Effect on Businesses Research. All right, so let's all look at this together. Okay, remember this is actually a philosophy class, although it's primarily about the business enterprise. And in philosophy, we write argumentative papers. Okay, this is an ethics class, and I want you guys to write a paper where you present a particular point of view and then defend it. Okay, try to convince others like you would in an argument. Convince others of the correctness of your position. So I'm not looking for papers that are bland recitations or descriptions of a series of events or just analyses of a text or something like that. I'm looking for papers that make an assertion, a punchy assertion preferably, and that then defend that assertion like you would do if you were in a late night argument in the dorm with your roommate or a hallmate trying to convince them that you're right on a particular topic. Okay, now let's look at this paper. This paper is trying to convince us that unions are bad. Okay, this is generally a successful introduction. The introduction is nice and short. Short introductions are almost always best. And it finishes with a thesis statement. All your papers should be thesis-based. Please be careful about this. Okay, a good thesis is going to be short, it will get to the point, and it will tell your readers in very succinct style precisely how you're going to defend your main point in your paper. And in this particular case, her thesis actually contains clauses that correspond to the headings of her main sections in the paper. And that's a good way to write a thesis. So let me just read it for us. Labor unions are harmful in the retail workplace because they cause companies to collapse or go bankrupt. They cause companies to lose money due to initiated public disturbances in the form of strikes. And they cause an increase in unemployment. So there we have it. 3 distinct points. She's going to be arguing that labor unions are harmful because they lead to bankruptcy for companies, at least in some cases. They cause public disturbances in the form of strikes, and they also increase unemployment. Okay, she's going to do a good job of this, generally speaking. I think this paper got an A-. I'll tell you why it didn't get an A in a minute. But one strength of the paper I want to say at the outset is this is well organized. Okay, sometimes some students write best when they outline before they actually start their paper. Other students write best when they just start their paper and then create some structured outline about halfway or 3/4 of the way through. You know your own writing style best. This paper pretty clearly is well structured, so that's one of its strengths. I like her use of topic sentences. Let's go to the first section. Labor unions cause companies to collapse or go bankrupt, which overall harms the economy. Not a very elegant sentence, not especially well written, but it gets to the point and it tells us precisely what she's going to be arguing in the course of this section. Okay, this section is divided into 2 parts. Okay, one part is a theoretical part and the other is a practical part. And that's the way I've actually already encouraged us to write our papers. You don't have to write your paper following this format, but it works for her on her particular topic. Her conceptual part, her theoretical part, is too short and not sufficiently developed. Okay, she should have spent some more time telling us in the theoretical component of this argument that labor unions cause companies to collapse or go bankrupt, telling us conceptually how that happens and not just going immediately to her case example. She does have a nice case example though, and that's the strongest part of this section, the General Motors filing for bankruptcy case. Okay, moving on to the next section. Labor unions that initiate strikes cause certain companies that are affected to lose an enormous amount of money. Okay, and then she proceeds to define what a strike is and talk about why a strike is disruptive. But again, it's a little bit underdeveloped. The conceptual part of her paper here still isn't sufficiently expansive in telling us precisely what strikes are and why strikes are damaging to the society. Okay, the examples, again, are the strong part of this, and they're relatively succinct, so that's good. The UPS strike is solid. The New York City Transit strike is a solid case study. So those are the strong parts of this second section. I like her use of facts rather than hand-waving. That makes it evident that she's actually done her research. And in general, I'll make this comment about her research. It comes from a variety of different sources. Okay, if your source list reads like the first page of a Google hit list, that's probably insufficient variety. You need to look around a little bit more. Okay, because those will probably mostly be talking about the topic from a particular perspective, rather than looking at it from a variety of different perspectives. Okay, comments or thoughts so far, or questions so far before we continue with the paper? Yeah, Elijah.
Actually, like when I was in my high school, we would do argumentation